Hey, welcome back to the show. Total Financial Solutions, Safer Money Hour. Okay, your family's financial life, right? What is it all about? Well, it's going to start with a couple of things. Often your employer will have a retirement account, and the retirement account is specific for you. In other words, what they do is they go through and they say, okay, we're gonna find an option to help either increase benefits, right? Sometimes they do it that way, to increase retention. Sometimes that's part of their reasoning for doing it. So you're going to sit there and say, how do I participate in this? Well, you're going to be able to participate simply enough if you are able to contribute to your retirement account. If you can't contribute to your retirement account, sometimes for people, it's just not something they can afford to do. Sometimes your employers will do a matching plan. And believe it or not, this is something you have to, I think you just have to make it a priority. Just like how many times have we gone through life and we said, okay, just tomorrow, I'll do it tomorrow. And then before you know it, tomorrow either never comes or tomorrow is in a position where you can't afford to do it because you're not just used to it, right? Your retirement account is much more important for your future because your retirement account that your employer matches is free money. That means you put in money, your employer puts in money, and sometimes they will match no matter what, which means whether or not you put in money, they put in money. And those are very important pieces for you to sit down and say, I can build that profitability through building up my retirement account and through, believe it or not, just consistent investing, because there's something called dollar cost averaging.
That's right. And what that basically means is you're going in and you're buying investments or financial products at different times of the month. So if you get paid every 2 weeks or on the 5th and the 20th or 1st and the 15th, you're systematically putting money into this program. And if you the way you direct it makes all the difference, but the whole idea with dollar cost averaging is when shares are more expensive of a particular product, you're buying less of them with that same dollar amount. But when those share prices go down, potentially, you're buying a little bit more. So you kind of see this average over time of buying some a little bit higher, some a little bit lower. But in all, what you're doing is you're systematically saving, which is a very healthy thing to do when it comes to your financial life, especially when it comes to retirement. But then you're also giving yourself some opportunity with the dollars that you're putting into these buckets or into these accounts. Because conversely, if you were just to say, okay, every 2 weeks I'm going to take $100 or $200 or whatever dollar amount and just put it in the savings account. Well, you could do that, but you would pay tax on it, because you'd have to take that money, pay your payroll taxes, and then you'd take after-tax dollars and go and put it aside. And then really, what can you make in a savings account? Well, they're not what they used to be. So in today's world, it kind of makes sense to take some of your money and put it somewhere else. Now, you have that retirement account at work. Arif mentioned a match or a contribution from your employer. So you're putting money in. Your employer's putting money in. If you direct those in the same place, maybe you're getting a tax break on that, and you're evening out kind of that investment risk, if you will. So over time, you have kind of a more healthy approach than just saying, I'm going to take all these dollars, pay tax, and put it off to the side, not earn anything. You're actually putting something where you can have some buying power in the future, potentially, and hopefully keep up with inflation. Because, that's really what we're all trying to do, in addition to saving money for retirement.
And this takes place through the process of that dollar cost averaging, right? It's because you're buying things when they're a little higher, when they're a little lower, and you can smooth that out because nobody knows as much as folks think they can time the market. Nobody knows when the highest or the lowest is going to be. So by consistently saving through that retirement account, it can give you some options. However, there is something called an in-service rollover or in-service distribution, which means you are allowed to take money once you hit the age of whether it's 50, 55, or 59 and a half. It depends on the firm and the company and all of that you're with and the plan, where you can take the money that you've already received the match on, you're already vested, and just remove a portion of that or all of it and keep the account open, continue to get a matching, but take the big chunk of money that's already there and remove that from the fees and the risk, and find a place where you are not paying fees, and you're not paying sometimes exorbitant fees. We had one just the other day, was 3.5%.
Oh my gosh!
They didn't even know it. Where that's eliminated completely, and you're now building in your own retirement account kind of a true diversification. So you're getting the benefits of both worlds, the ups and downs, up and down. You're buying, and then once you say, oh, the market's at all-time highs, which is right now. Right? You understand, if the market is an all-time high, or virtually, or pretty darn close, if not exactly, right? We're pretty close. Does it not make sense to take some of the profits, some of what you've earned, lock in those gains, and move that off to the side? We don't know when the market's going to go down, but it's safe to say that if you bought something in the last 2 years, 4, 5, 6 years, you've been putting money in your account, maybe more, that it's higher today. So doesn't it make sense to buy low and sell? Follow me. Sell high, right? So taking some of those off to the side, if it's the right thing to do for you, and move those into a safer place where you can get reasonable rates of return. We're not talking, 20%, but I'm saying 3, 5, 6, 8%, somewhere in between there, where you're saying I'm averaging over time 3 to 8%, 4 to 8. Can I still be in a safe place and not run the risk of losing it? And the answer is yes. Don't let the market trick you into thinking, and brokers, if you will, some of them out there will try to say, oh, you have to take risk in order to have for the gain. Look, you've already made your money. You're going to do it in your field. You're good at what you do. So how is it that you can create wealth by having your broker invest? I don't think that's the answer. I think to maintain, to grow at reasonable rates of return, our job is not going to be to make you rich. Any broker that says that is I think, surprisingly ill-informed. And really simply, why? Is you just ask, how much money do you have, sir? Right? If you're coming to work every day and you got to show up at 6 a.m. because you're in the market, and you got to work weekends and holidays and study and go to school and wait, I thought you said you could make me rich. Why aren't you making yourself rich first? Because the job is to maintain. It's to grow your wealth slowly. And if you can do that without risk and fees, maybe it makes sense to put some of it off to the side.
Well, and I think it's important to define this process you're talking about, Arif, this in-service rollover, because traditionally, if you put money into a retirement plan, taking it out before you reach your retirement age means that you not only pay taxes if you haven't paid taxes on it yet, but there's also something called a 10% penalty, or in some cases an excise tax, as you may have heard it called. And that just means that if you do not reach the age of 59 and a half and you pull money out of this retirement account just to go spend it on a pair of shoes or buy a car or pay for your kids' college, it's a different conversation, you would have that extra tax penalty. And currently it's at 10%. So what are we talking about here when we're saying systematically put money into your retirement account, build up this nest egg over time? Now we're seeing a lot of profitability because the market is at an all-time high, or very close to it, as Arif mentioned. How do we take some of that cream off the top? How do we say, I want to take these profits and remove it from the risk and the fees? We're talking about an in-service rollover or in-service distribution. And what that means is, normally in the past, if you wanted to roll over your retirement account, you had to quit your job or get fired or whatever have you. It was called separation of service. But an in-service means you're still working for the company or the organization. If your plan document or the plan document of that retirement plan allows, that's basically the rule book, if you will, of that retirement plan that says, hey, if you work 1,000 hours or you make this amount or you reach this age, you're able to put in. But what about taking money out? Oh, well, you can take loans, you can take hardship distributions, or an in-service rollover. And that means the money you've deferred from taxes gets to come out of the 401k or the retirement plan. You can put it into your own, basically a self-directed individual retirement account. It preserves its tax status, but now you have some different choices. Because what happens there, if traditionally when you're investing or saving money in a 401k or company retirement plan, what do they typically offer you as an investment choice?
Well, when you're at work, it's truly just the market.
Right.
Wall Street's job is to go out and accumulate assets. While you're busy going to work every day, don't you worry your pretty little head. We'll take care of your retirement accounts, and we're just going to fee it, and we'll fee it. There may even be funds and types of accounts in some of these 401k accounts that are so subpar that the only way that they can get any significant number of assets, of dollars coming in, is by having them blindly put into basically an unsuspecting group of 401k contributors. Not because the very smart and informed money manager and institutions out there are putting the money there. It's because you're just going to work, closing your eyes, 25%, 25, 25, 25. And why did you choose these? Oh, I don't know. I just thought it'd be good to mix them around. Oh, okay. Or what is this all about? Here's a retirement account. Are you happy with it? I don't even know. Well, do you know what kind of rate of return you're making? Nope. Because Wall Street expects you just to go to work, do your job, wake up at 60, 65 years old, and see if there's any money in the account and how much, and oh my gosh, you did pretty well. But you know, you're earning interest in those accounts cumulatively on an annual basis, but it can also go backwards every year.
Right.
But the fees are never returned to you every year. So they are charging fees on the same money that they charge a fee on every single year. Fee, 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 fee. And they just continue to do that. And your account goes, oh, we made 5,000, we're down 2,000. We're up 6,000, we're down 4,000. Right? But the fees are always going up. Now you can say at the end of the conversation in your research, you know what, I did all my research, and at the end, I think it's a great idea and it's a good, fantastic. I never say that it's bad or good for there isn't a product good or bad for everybody. Your 401k account at work may be amazing. You may know exactly what its strengths and weaknesses are, and then you complement the other side outside. That's what you're supposed to do. My concern is in the folks that are not familiar with it, that are going to work every day, that are kind of trying to do their job, and they're not necessarily that sharp in this world because it's just not their thing. And yet, behind the scenes, there may be folks taking advantage of you, and that's the thing that we want you to be careful of. Grow some wealth. Don't put all your eggs in one basket. Slowly, as you can, start moving money out of risk and into safety. That's called the rule of 100. Right? We've heard of that rule before.
Right. So basically take your age from the number 100, and that's the amount you should probably have safe. So when you're looking at that, as you're getting closer to retirement, even 10 years before retirement is not too early to start looking at this and taking a more conservative approach to where you keep your money, how you direct it. Because you may think that, oh, I've got a lot of time. But how about the people that wanted to retire 1-2 years before 2008 crash happened, or maybe the year or two after that? Nobody knew if the market was coming back. Nobody knew how it was going to come back, or how long it would take. We've seen in some cases where it takes a decade for someone to say, okay, we're now back to even. So did you work for free for the last 10 years? I don't know. I wouldn't want that deal. You don't see people raising their hands saying, sign me up. But it happened. And it happened at a time when everybody was on kind of a high, saying, oh, you know what, I think everything is good, and the country is great, and the economy is doing well, and everybody's making more money, and the stock market's up. And what happened next? So this is a great time to take a look at what you're doing. And if you think you're even going to retire in the next 5 years, look at some of the history and let that tell you where you may want to make some changes. Because right now, there are more tools out there than ever, right? I mean, wouldn't you agree there's more places to put your money than there were 20 years ago, 30, 40 years ago? So does that make it a better landscape for us? No, I just think there's just more information and there's more confusing things. Do something that's prudent, save regularly, pay yourself first, treat it like a bill, and we've got that box checked. Great. Now we've built up some savings. This in-service rollover could be one of the most powerful things when it comes to funding your retirement, because it's money that you can take. And Arif, I want you to share this. Your story, your example of a bus with 20 different seats is probably one of the best analogies I've ever heard.
Yeah, we've tried to give you examples so that it can be clearer to you, but think of it like this. In the world of diversification, right? I love it when brokers and experts try to say, oh, well, it's diversification. Okay, what does that mean? Does it mean you just lose money in 5 different places? Or does it mean that some go up and some go down, and you're okay where not all your eggs are in the one basket? Okay, so here's my example. Think of it like a school bus, or any bus for that matter. It's a school bus, and you're sitting in the front left. That's the most risky place in that bus. That means if you hit something, you're the first to feel it. If you go over the edge, my gosh, you're the first to hit the ground. So you say, I'm going to be safer. I'm going to move to the middle right side of it. Right? I'm going to switch. I'm going to go to the middle right side. So see, I'm now diversified. Well, do you understand that no matter what happens, wherever you sit on that bus, when it goes over the cliff, it might take you a little longer to get to the bottom, but you're still going to hit the bottom. So we say get in a completely different vehicle altogether. Leave that bus and get into a different vehicle where it can go a little slower, maybe turn a little sharper, maybe go a little faster, maybe stop faster. All of those things are much, much more important than saying everything is in the stock bond mutual fund world. So I'm going to go from the most aggressive stock bond mutual fund in the front to a balanced equity growth income into the middle, and then I'm going to be in bonds, which is to the back. Do you not understand that people say, oh, I have my money safe, it's in bonds? Okay, well, let's call up the broker and say, can bonds ever go backwards? Yes, they can, which means you can actually lose money, yes. But not if they don't sell. Well, then if I don't sell, then how am I supposed to spend it? I mean, I get it, but do I never get to sell? Oh, you do. But what if I need it and it's down? Oh, well, maybe that's when you lose it. Right? So follow along the way, because these are dollars that are yours. When we come back, I want to get into the next phase here and give you some solutions as we finish up. Questions to ask anyone who handles your money. And I want you to ask these questions and research the answers, right? Because a lot of people will say, oh, I asked 10 questions. They'll come to me, they'll ask 10 questions. But goodness gracious, they don't know what the answer means, right? So if I say yes or no or always or never, they don't know if that's a good thing or a bad thing, or should I do more or less, right? So know what the answers are and what they mean when we come right back. Total Financial Solutions, Safer Money Hour. This is your hometown station, KHTS. I'm Arif Halaby. That's Jeff Gerard. We'll be right back. Hey, welcome back to the show, Total Financial Solutions, Safer Money Hour. Arif Halaby and Jeff Gerard on your place for news, talk, and information. This is your hometown station, AM 1220, KHTS. All right, look, how do you handle the choices that you make when you say, am I going to work with this particular financial person? Am I going to say that this financial advisor, financial professional, whomever you choose, and they mean something different, just so you know, they're different terms. They don't always mean one is better than another. It just means they're different. They have different responsibilities. Okay, so here's a couple of things that I want you to ask. Number one is, how long have you been in the industry? Now, this is important for two reasons. I think number one is there's training and experience that can only come over time. I think somebody who's been in the business for 5 years is probably not as sharp as somebody who's been in the business 10 years. And if you just took time, it's probably not as sharp as somebody who's been in the business 20 years. Because time alone doesn't always, can mean the experiences are different and even better, right? So that's important. How long have you been in the industry? But the second reason, I think, is because there has been multiple things over the last 15 or 20 years in the economy that has changed our industry. And you need to ask yourself, do I want somebody who's only been a part of the industry and part of the financial industry since the market has just been going straight up the last few years? It's just been going straight up. So that's the only thing they know, right? That was me in 1996. When I started in 1996, the market had pretty much gone straight up for 5, 6, 7 years. And it did for 96, 97, 98, 99. I couldn't do anything wrong. Whatever I said, it didn't matter. Just say over time, the market's going to go back up. And it did a few days later, until 2000 happened. And we had 3 years, nearly 36 months of a down market. That's pretty darn scary.
I would say so.
Second question. How much longer do you plan to be active?
That's a great question, because if you've got someone that's leaving the industry in 10 minutes, who's going to take over your financial life? If this is someone you are expecting to be there to see you not only into your retirement years, but through your retirement years, that's a consideration. Does that person, now let's say this person, because you can't have it both ways, right? They've been in the industry 40 years and they're going to be in the industry another 40 years, and they're going to be alive and practicing the whole time you're alive until you pass. Well, and they're going to be there for your family too. No, it can't happen that way, right? But do they have a contingency plan? Do they have a succession plan? What if they want to retire? What if they pass away? Is that person the only one in that office that can help you?
Yeah. How many other people are licensed? You want to know that as well. There's a level of training that takes place just to get a license, really. And that alone, and then there's continuing education, and there's an ongoing stream of things. That itself, right, on this consistent basis is very important, because part of what happens in the training world, and to get your license and to keep it, means there's a level of conversation that can take place that's at a little bit of a higher level. In other words, people understand what's going on. They have a grasp of what's happening with the market, the economy, the process, the paperwork, the products. All of those things are of a level that's very important to grasp. And in addition to that, if somebody gets sick or is hit by a truck or can't work or passes away, even if they plan on being in the industry for a long time, does the office have a plan B, this contingent plan that just continues to roll along for you and your money? That's important to ask. And don't be shy about asking those things. It's not always comfortable, and I understand that, but it is something that you need to ask.
Well, because this is your money, and who else is going to look out for it but you? And if you hire somebody or you partner with an advisor or a consultant, someone that's going to play part to that, you want to make sure that they have, basically a vested interest as well.
Yeah, and then the next thing is, how are they making money? And ask how much. I don't want you to ask, oh, what is my fee, right? Because a fee is a different thing. What's my total cost? Because with some mutual funds, some 401ks, you're looking at between 16 and 18 different levels of fees. There's legal fees, there's this fee, there's all sorts of fees built into your retirement account. And your 401k account, you need to know, what are my fees for that account? Am I making any money by this? Or do I start out the year 5% backwards, and then I just have to start making money before I move forward? You need to know that, because this is very important. We understand, brokers have families and mortgages. We get that. But also realize that you're not doing this to make their car payment. You're doing this to make your car payment in the future, and much more than that. So,
well, and a prime example of that is someone that comes to mind that thought they were paying $35 a year. They say, hey, I've got X amount of dollars with this firm. They've managed it all these years. I only pay $35 a year. And it's funny, that's a number that I think happens quite a bit to people. They hear $35 and they think that's all they're being charged. Yet there's an underlying expense or cost or fee. Those are three different words. So be very careful in what you ask, and to Arif's point, how you ask it, because you may only pay a fee of $35 for the whole year. Wow, I get to meet with them 3 times or 2 times or once. That's great. But is your money being deducted of those costs or expenses or those other things that could be playing part to your money never growing in the way that you had hoped it would?
Yeah, some accounts even have 403B. They have like a 403B or 401k. They'll have a 12B1 fee. They could have a M&E expense. Some accounts will have administrative charges. But do you see what I said? 12B1 fee, M&E expense, administrative charges, expenses, fees, charges. Those are different terms, different names for the exact same thing, which is taking money from your pocket and putting it into theirs. So ask those questions. I don't care if they say it's only 1%, dollars. I don't spend percentages, sir, ma'am. I don't spend percentages at the grocery store or on my electric bill. I spend dollars. So what are the dollars that it costs me each month? Because I get paid monthly. My bills are monthly. Just speak to me in monthly terms. What is my monthly cost to keep this account with you? And if they say it's whatever dollar and you're earning this, so you pay this and you're making a higher number, it's a great deal, right? If it cost you $1,000 a month and you're getting you're earning $10,000 a month, then I think you bought something good. It's a good deal. Let's take 2 of them to go, please.
Sign me up.
Right? I'm good with that. What I don't want is the opposite. Wait a second. I lost money last month or broke even, and Mr. and Mrs. Broker, you're the one that made money? Wall Street made money? I'm the one that worked for this money? A good example is a recent account where a client was putting in $250 a paycheck. Into their retirement account, $250 every paycheck. They got paid twice a month, 1st and 15th. They were depositing it. We looked at the fees in the account, right? They've had an account for quite some time. We looked at the fees in the account, and the fees were $750 a month.
Oh.
So that means 100% of what she was putting in was going in and out the back door to the broker, or at least the company. Whatever they did with it is, I'm sure they gave the broker some of it. But it came in the front door and went out the back door. And so when we called on the phone and she said, wait a second, what do you mean my fees are this much per year, which broke down to $750 and change per month? She said, well, we're doing this because we manage this. And you just listen how they try to justify. She said, but I'm putting in $250 a paycheck or $500 a month. They said, yep. So that means I start out negative every month. So it's like swimming upstream. Before you even go anywhere, you got to beat the current, then you get to go over. So just know, and if at the end, let's say she was paying $20 a month and she was making $500 a month, Okay, I'll give you $20 to get back 500 all day long. So just know what the numbers are and see if it's right for you. And if it is, great. If not, then have that conversation about making some adjustments. Certainly, you're welcome to call us. That's one of the things that we do is we help kind of explore and decide if this is right. Let me give you our phone number. It's, of course, a local number, 661-753-9683. 753-9683, or you can go to Total Financial Solutions. You can click through hometownstation.com. That's hometownstation.com. Click over to Total Financial Solutions, send us an email, and we'll be happy to have you pop in, and we can make some phone calls, see what we can find. If we can find out for you, we'll be happy to go over that. All right, here's another question. Give me another one, Jeff.
Well,
what is it that you want to ask?
Well, I think a good testament to the advisors or your financial professional's recommendation is how much of their money do they put into the products that they're recommending? Because a big part of it is it good for the goose and for the gander, or is it just good for you to put it in because they make a high fee off of that? So we've seen a lot of times where, and a big part of this has come in where you see a lot of captive agents, not all of them, but a good portion of them, have a particular product that they recommend to everybody. And how convenient, it's also one of the highest paying commissionable products out there. And you see that and you say, wow, why would someone recommend this to someone? And lo and behold, they've been paying for 7, 10, 12 years into this, and it doesn't really seem like it's making any headway for them. That's kind of a sad thing that it's taken that much time for someone else to catch it outside of the person they've been trusting and putting money with. So is this something that the person that's helping you with your money, are they investing in this? Are they saving money in this product? Don't be shy to ask those types of questions because I think they're important.
And what that does for you is it gives you choices when you are looking at, and don't expect that broker to have everything with that company.
Sure.
I'm okay with that. They shouldn't. They should have a diversification approach as well. But think of it this way. Some of the big carriers out there that can only sell their company's products, they'll often go out. So if you think of the big, State Farm, Farmers, Allstate, a lot of those guys have to sell their company's products, rightfully so. They're the ones helping pay their electric bill and their desk, their expenses to run their office. But if that isn't the right place for you and there is another place for you, they don't always have that option. And the sneaky thing that is kind of like everybody knows but nobody says is they'll often have a mother or a sister or a wife or a husband that is also licensed but independent. So sometimes they'll say, I can't place you with the company that I work with, so I'm going to sneakily send it out and it's going to be written under my wife's name or my husband's name. Now, okay, that's fine if that's what they have to do and maybe it's better for you, but you just have to ask yourself, gosh, if it's that sneaky, is that the right way to go? I don't know that answer. If it has to be done in a sneaky way, does it mean it's the right thing? Maybe. And then also look at this. You need to see this particular account has to be there has to be a point in time when it's not good. Now I don't know if that's once in a lifetime, once a day, once a week, but if everything is always good and we're always buying, is there ever a time to sell? If they're telling us we think you should be, and then the opposite I see, where every couple of days or weeks they're in there selling and flipping and getting rid of that and buying this. And so if they're doing it at a profit, okay, fine. Then make sure that the cost to make that trade isn't eating up your profits. But if they're just buying it to sell it, to buy it to sell it, so that they can seem like they're busy and they're not quite productive, know the difference. Your retirement accounts have to be productive, not just have your broker busy. This is your retirement. Nobody else is going to take care of you in retirement. I don't think the pension system is going to be there the way you think. I certainly don't think Social Security is going to be there under its current scenario. Thanks for joining us, folks. I'm Arif Halaby. That's Jeff Gerard. You can get a hold of us every week at this time on your place for news, talk, and information. This is Total Financial Solutions Safer Money Hour on your hometown station, KHTS.